Good evening, everyone, and thank you for joining us. Welcome to Ironwood Wealth Management's Market Insight webinar for the fourth quarter of 2016. My name is Nick Basso, and I am a Portfolio Administrator in Ironwood's Asset Management Division. And tonight it is my pleasure to introduce our featured presenter, the Chief Investment Officer here at Ironwood, Mr. Sean Rogers. Sean is a charter holder of the Financial Analyst designation, and he also serves as Ironwood's primary investment strategist. If anyone has questions for Sean during the presentation, please feel free to type those into the chat box on the GoToWebinar panel on your screen. I'll compile the questions and we'll do our best to address them at the end. And now, without further delay, please join me in welcoming Sean to lead this evening's presentation. Sean?
Thanks, Nick. Thanks for everybody for taking the time tonight to call in. I'm going to start off by apologizing for my voice and probably a cough or two here. I'm battling a pretty nasty cold this week, but I'll try and get through this without too many interruptions. I know everyone is here to hear my wonderful recap of the World Series. No, you guys aren't listening in today to hear my recap of the historic World Series. If you didn't know, the Cubs did win. But we had a little election a week and a half ago, and most of you are probably wondering how that's going to impact your investments and what that does to the economy. So we're gonna spend a considerable amount of time tonight kind of going through what our thoughts are, what we see, how it's going to impact things. And what I'm going to do is I'm going to start off by going through the U.S. election and kind of some of the long-term implications. And then I'm going to go through the normal insight and kind of add some flavor on where certain policies or projected policies will impact different areas depending on what we're talking about. So we'll start with the election, and then we'll kind of go into the normal, how does it affect and how does it play in, and how is the economy doing. So with that, I'm going to go ahead and start off with the U.S. election. As everybody knows, Donald Trump did win the electoral vote, 306 to 232 electoral votes, although Hillary Clinton did actually have about 1 million more votes nationally than President Trump. President Trump. One of the things that when I was looking and kind of looking at the past 3 elections, one of the things that caught my interest was the differences between the vote. And so I'm going to quickly go through the last 3 presidential elections, just because I did notice, and I highlighted here the other vote, 7 million versus 2 million. So in 2008, McCain roughly got 60.5 million votes. Obama got 70 million votes, and the other candidates, or write-in candidates, got 2 million votes. So 60.5, 70, and 2. In 2012, Romney almost matched McCain at 61, so he had 500,000 votes more, 61 million. Obama dropped from 70 to 65. Again, write-in candidates and other candidates were 2 million votes. This year, Trump had a 500,000 more than Romney, so it's 61.5. So all 3 of those, the Republican candidate was pretty close, within about 500,000 votes away from, 61 plus or minus 500,000. So very similar. Whereas the Democratic candidate We had Obama at 70, Obama at 65, and Clinton at 62.5. And I'm rounding a little bit. But one of the interesting things in this most recent election was that the other votes and the write-in votes were 7 million votes this time. So that's 5 million votes. So it really was the election where there were a lot of people, well, a lot of people just voted based on if they're a Democrat or a Republican, they voted in line with their party. But there were a lot of folks who went outside of the party and voted for somebody else, and I'm sure there were many other people who just didn't vote at all. So I thought that other vote was a pretty significant change, and so I did want to mention it here. There's been a lot of talk recently from the Republicans that they're going to do the will of the people. I think they ought to look at what really has gone on, because it was a very close race, even though the electoral votes don't seem like as close. It was still a very, very close race. I mean, when you have a candidate who wins the national vote but doesn't win the electoral college, it was probably pretty close. Anyway, we did have a Republican sweep, first time for a while that we've had President, Senate, and House, although you don't necessarily call Trump a normal Republican. Trump is inheriting a decent economy, and we'll go over that in subsequent slides. I kind of battled with myself on where I was going to put this U.S. election slide, and I know that there's probably a lot of interest in it, so I thought we'll probably lead on it. But when we do go through some of these other slides, we'll talk about some of the stuff as well. Trump has an ambitious agenda. Some of the things on his agenda: tax reform, lowering the corporate rate. A lot of things say from 35 to 15. Possibly doing some repatriation, bringing money from overseas to the United States. We've got tax reform on the individual side. Many things say less complicated, 3 tax brackets, getting rid of a lot of the deductions and kind of making it more streamlined. So we'll see what actually comes out. Those are some of the things that have been talked about. Affordable Care Act or Obamacare replacement. Lower regulation. There's been a lot of talk about Dodd-Frank and watering it down or replacing it or get rid of it. Bank stocks have rallied off of that news, and many other regulations, not just Dodd-Frank, but Donald Trump is not a fan of over-regulation. And then he's talked about fiscal stimulus, infrastructure spending, immigration reform. So we don't know what exactly is going to happen, but it seems like a couple of these things, with how the House, Senate, and President line up, seems like he's going to probably be able to get some of this stuff through. Tax reform seems very likely. ACA replacement seems like it would be more difficult. Same with some of the regulations, but it's definitely doable. Fiscal stimulus seems very likely, and these are things that could actually change as early as 2017 with the way that some of the government processes work. So they could actually retroactively change the tax code for 2017. So what are a lot of the things that, if you're just looking at these policies, maybe not individually, but what kind of things do they all have in common? They're inflationary, which to an extent isn't a horrible thing. They're going to create growth, and we'll It's yet to be seen if it'll create long-lasting growth or if it'll be more of a jump start and then fade off, moving future growth sooner, rather than really focusing on some of those productivity type of things that are more longer lasting growth areas. Deficit, an increase in the deficit is likely. And then if we get some more inflation, it might make the Fed move quicker on interest rates. And we've seen a lot of that recently, so I'm gonna jump into kind of the economy now, but I'm gonna overlay the election throughout the whole presentation. So before the election, believe it or not, we saw an uptick in the global expansion. It definitely picked up even before the election. The global manufacturing index, you can see in October, hit 52. That's the highest reading in 2 years. And if you look at each of the components inside of that, they were all rising and at a faster pace. And you can see some of these individual, the U.S. and the Eurozone, all picked up very, very nicely. Not just manufacturing, but some of the service areas as well. At the start of this quarter, so September 30th, October 1st, the 10-year Treasury, believe it or not, was at 160. That was at the end of the quarter. As of today, a month and a half later, that 10-year Treasury is now at 2.26. I'm going to spend a little bit of time talking about that and how the yield curve has changed since the election. So that's all I'm going to say about it right here. Manufacturing, 51.9 in October. ISM non-manufacturing was 54.8 in October. That's 80 straight months of expansion for non-manufacturing PMI. U.S. economy created 161,000 jobs in October. The unemployment rate fell below 5% again. It's actually at 4.9%. The U.S. employment is showing signs of very, very, it's showing very strong signs. Just this morning, jobless claims came out. They were 19,000 jobs below. They're at a level we haven't seen in 43 years. So this economy is not an economy it's an economy that's actually picking up. And this slide shows that we had a deep recession. The financial crisis caused a deep recession. You can see it's the biggest recession here, biggest trough, and it's taken a long time to get to where we normally are. And if you were to look at where we normally are, you're going to see that most of these expansions, you're at the level of GDP that we're at, you're at between 2 and 4 years. There's a lot of these right here at 8 quarters, and there's a lot of these here at 16 quarters. So 2 to 4 years is where the GDP growth is in relation to past expansions. So even though this is we're past the 7th year of this recovery, this expansion, it doesn't necessarily feel like it because GDP growth has been so muted this time, and it hasn't been like these past expansions. So you could make the argument that we could go a lot further. And if we look at it just a different way of looking at this, the last 10 bull markets, duration in months, we're at 90 currently. That's 5 out of 10. So right in the middle of the 10. If we look at price gains percentage-wise on the equity markets, we're at 186%. That's 6 out of 10. So we've got 2 measures that say if this was a really deep recession, we would expect a pretty robust expansion and bull market, and we're in the middle stages of that. And then we've got our PE, which is the outlier here. It's the second ranked. The max PE of this expansion has been almost 24. That has a lot to do with how bad earnings fell during the Great Recession, and it also has a lot to do with where interest rates are compared to other bull markets in the past. But even if we have two of the three, you can make an easy argument that this bull market could still run for a lot longer. So that's the only point I was trying to make with those two slides. The U.S. labor market is starting to tighten. I mean, it's starting to pick up, and it's starting to show some inflationary signs. You're starting to see wage growth pick up. We're basically, at any economist's definition of full employment, we're pretty dang close to that at 4.9%. Like I said earlier, the jobless claims this morning at 19,000 lower. That's a level we haven't seen for 43 years. Continuing claims, very similar story there this morning. If we have an agenda of fiscal stimulus and tax cuts, then that's only going to make this tighter. And that's only going to create more wage growth, which is going to create some inflation and inflationary pressures. In fact, this is the wage growth that's calculated and has been calculated. The Atlanta Fed actually measures wage growth a little bit differently. They take out everyone who's entered or exited the labor force in the last year to try and get it as, okay, let's look at the people who have been consistent in this labor market and look at their wage growth. That number is actually a percentage point even higher. It's at 3.5%. So we have seen an economy that's ticking up in respect to employment, inflation, and that's before this election even occurred. The cyclical sectors, you can see light vehicle sales. That's a very positive trend there. This is before the election. Inventory is coming down. They've since come down even more to start to stabilize. We have housing, which is in a good trajectory. September kind of had a downward tick. This morning, housing starts increased by a whopping 25%. The analysts were shocked this morning when they got the numbers, and they were all very quick to say that housing numbers are usually there's a lot of noise in there, so we don't want to get too excited, but it is definitely going in the positive direction. And these are all things that happened before any talk of tax cuts or fiscal stimulus or deregulation. So you can kind of see that these three look pretty good. Real capital goods orders, although it's ticked up a little bit recently, the trend is not positive. A lot of that has to do with, sorry guys, a lot of that has to do with energy companies and lower spending due to lower oil prices. But if we get lower corporate tax, repatriation, and fiscal stimulus, you'll probably see this tick up at a good pace. Consumers are very strong. This story has not changed in several quarters since we've been looking at this. Like we said in the previous slide, wages are up 2.7%, maybe even higher depending on which metric you're looking at. Gasoline prices are still relatively low. Housing is still relatively affordable. We've got a decent job market, and you've got consumers that are cautious, and they've positioned themselves on their balance sheet $7 in assets to every $1 in liability. So net worth is at an all-time high. You got the stock market up. Consumers are feeling pretty good. So that's a positive, considering that the U.S. economy is 70% consumer spending. Internationally, a little different picture, not as rosy, but some of these international economies are a little bit behind where the U.S. is because they took a different route with monetary policy. Europe is starting to tick the right way. Their leading indicators and their growth have been improving. Their unemployment's been falling. They have still a lot of slack in their employment. So that could actually be a tailwind as they create more jobs, more people working. That's going to add to their growth. That'll be a tailwind, whereas the United States, it's going to be a lot harder for us to bring down our unemployment rate much further than where it's at right now. And then also, Europe is still doing a lot of monetary stimulus, which is going to be positive for their economic growth. Japan is doing a massive fiscal stimulus that they started last quarter. Wages have been increasing. You can see the little pop here, but still, it's just kind of a better than worse. But they have still been doing this massive fiscal stimulus, and their unemployment is low. And we believe that some of the earnings developments have been positive in some of our Japanese companies, and if you look at Japan as a whole, the earnings have been pretty positive there. China looked great earlier this year. I mean, their economic picture looks great. With Trump winning, it's made a lot of people nervous about how the United States is going to react to China now. But if you just look at the economic data, China has improved dramatically from the slowdown in the summer of 2014 and 15. And they've been improving dramatically, and that's shown in earnings increases as well. And before the election, China makes up 26% of the MSCI Emerging Markets Index, and that Emerging Market Index before the election was up about 17%. Since it's pulled back a little bit, it's only up about 12 for the year, but still, that's produced a pretty good rate of return in 2016, and it's a lot to do with China. China, over the last 10 years, has gone from 5% global GDP to 15% of global GDP, and that's not going to fade. They're going to continue to be more of a share of global GDP over the next 10 and 20 and 30 years. Their GDP is approximately $11 trillion, which is larger than the next 9 emerging market countries combined. Their stock market cap is $8 trillion, which is also larger than the next 9 emerging market countries. So what I'm saying here is when you're looking at emerging markets, you've got to look at China here. China's e-commerce is almost double the size of the U.S., and it's growing at a much faster rate, approximately 37% versus 15%. So there's a lot of positives with China. With positives, there are also some negatives. One of the biggest issues that a lot of investors are concerned with is China's debt issues. They have about 300% debt to GDP ratio. However, they also have a 3% current account surplus, and they are a major net creditor to the world. So we do believe that they need to get that 300% debt to GDP down, but we don't think that they need to do it in a big rush. Central banks and interest rates. Spend a little bit of time here because a lot has changed since the election in regards to interest rates. So this is as of the end of October. We had about 65% of government bonds with yields less than 1%. This number has gone down. We have 29% with yields that are negative. This number has also gone down. Before the election, we started to see global growth pick up, and we started to see a little bit of increased interest rates. But then the election, with some of these policies that could impact the U.S. and not only just the U.S. but also the world, if we start to see this global growth, interest rates are going to start to go up. Central banks around the world may have to start dealing with inflation, and we need to make sure that we're keeping an eye on this inflation. Right now, it's within the Fed's mandate, within a lot of these central banks' mandate. But if we combined before the election a very robust pickup in not only the U.S. economy but the global economy, and then you throw in tax cuts, stimulus, and deregulation, you could start to see some of this pent-up animal spirits come to fruition. And with the Fed, with the balance sheet that they have, with central banks, it just could prop inflation up a lot quicker than we want to see. And if that were to happen, it would probably be negative for stocks and bonds. A little bit of inflation is probably good for stocks, still bad for bonds. So I'll get into how that impacts the different asset classes here in a little bit. But all else being equal, a more robust global economy, and then you throw in some of these potential policy changes. That's why that first implication that I wrote down was not growth, but it was inflation. That's the thing that in all of the talks that I've been listening to, different economists and different theories out there, everyone is worried about inflation. A lot of folks are worried about inflation. I went the wrong way there. Okay, so here, let me get my little pen out here. So this was the blue line here. This was the yield curve 17 days ago, October 31st, 2016. So I'm going to attempt to draw the yield curve as it is today, to close today. So we're going to go here. We're going to go here. Here. Oh, skip that one. Go here and go here. Okay. So the yield curve looks something like this as of today's close. Oops. You guys get the picture. So in 17 days, it took us 3 years from December 31st to October 31st, 2016, almost 3 years to move down here. It took us 17 days to basically almost shift right back to where we were at the end of 2013. So that has a huge implication, and that is in our estimation, that the Fed is probably the good global economic data. The Fed is probably most likely going to be increasing interest rates a 1/4 point in December. And then also with the fiscal stimulus, tax cuts, deregulation. This is inflation expectations. And so you've seen that very quickly in the market. So just so you guys know, the 10-year as of today is at 2.26. That is 66 basis points higher than it was October 1st, which is a big move. Just to give you an idea, a move like that, since October 1st, the global aggregate bond index has lost 6%. 6% in the last month and a half. That is an astounding move for a bond index in a month and a half. Our bonds have not been hurt as much as the global aggregate, and it's because we were much shorter on the yield curve. We were giving up yield, earning, let's say, 1 to 2 to 3%, depending on our credit, and foregoing trying to earn 2.6 by going out 30 years. We thought that yields were low and that they would go up. So although our bonds have lost money, they've lost a significantly less amount than the global aggregate. Now, increases in rates are a good thing to a certain extent. Anywhere under about 5% on the 10-year Treasury is usually positive for stocks. It doesn't mean it's always going to be that way, but if you look at history, any increase in interest rates when interest rates are below 5% usually is positive for stocks. Another reason it's positive is that we have a lot of retirees in this nation who have more assets than they have liabilities. And in fact, if you look at household interest for the United States, before this interest rate change happened, we had household interest of about 1.4 trillion for income, and we only had 350 billion in expenses. So you're talking $1 trillion more when interest rates were lower. So if interest rates go higher, then that base, that income goes up, and our 350 billion won't go up as fast because it's a smaller number. So it is positive for savers, which a lot of retirees are savers, and they've had this invisible tax over the last 10 years or so with low interest rates. So although we're going to have to go through some pain of having to see our bonds depreciate in value, our new bonds that we go buy are going to have higher interest that we're going to be earning from them for years to come. So that's another reason that we've been short on the yield curve. We're hoping that interest rates are going to keep going up so that we have some better opportunities when some of our bonds start maturing, and then we can put those proceeds into bonds that are paying us a little bit more in interest, and we're getting compensated for the risk that we're taking. I mean, at 2.6%, when inflation is running at near 2 for 30 years, you're not getting compensated for the risk you're taking locking into a 30-year Treasury earning 2.6%. It's just not. The risk reward is not there. Okay, so I've got to erase this and then go back to this. And all right, this is just some past rate hike cycles. I think that with more inflation, with some of the president-elect's policies, all else being equal, the Fed might have gone slower. They did one rate hike last year in December. We're thinking they're going to do another rate hike this December. So they've got 2 rate hikes a year apart from each other, maybe, you know, if they do one in December. Next year, depending on what happens, and Janet Yellen was in front of Congress this morning, giving her outlook, and they were asking her questions, and they were asking her, well, are some of these policies going to change your mind? And basically she said yes. If fiscal stimulus gets put into the mix, it's going to change our economic forecasts. And so they may need to raise rates faster than they were anticipating, so that the economy doesn't overheat. I think if there's one thing that's a risk with all of this, it's that things go really well over the next year, 2 years, and then we start to overheat, and maybe that's in a year. But I think right now that we're in a period where risk assets can possibly do very well. I just get the sense from looking at the market movements since the election that there is a different there's a different wind in the air. It just seems a little different. The market leaders are different, and we need to make sure that we keep a diversified portfolio for each of our clients that can protect in case something, you know, in case we have hyperinflation. Those are all risks that we're anticipating and putting pieces in your portfolio that you might not like to have when the stock market's going up, but that if the stock market doesn't go up and we have a recession, or we have hyperinflation, or we have some of these risks that could potentially happen that we don't know what's going to happen, those are things that are going to protect us during periods like that. Commodities is one of those things that I think is going to be a really good piece to have in the portfolio. A lot of our clients haven't liked having commodities in their portfolio over the last 4 years. It's been, you know, a big laggard compared to other risk assets. But that happens when you have a diversified portfolio. You go through periods where an asset class is out of favor, and then you go through periods where it's in favor, and you want to make sure that you are buying the out-of-favor asset at low prices and selling the in-favor assets at higher prices. That's the whole goal to rebalancing. But I kind of went off on a tangent there. Oil markets and the U.S. dollar, not a ton to talk about here. The dollar has buoyed because of the uncertainty of trade policy. I think Donald Trump's bark is going to be a little bit worse than his bite when it comes to this, but the market doesn't know. The good thing, I guess, if we want to call it a good thing, is that the dollar already appreciated a ton in 2014 and 2015. So even at the current levels of 100 on the U.S. dollar index, compared to where we were at the beginning of the year, we're only talking about a 3 or 4% increase. That's not going to have a significant year-over-year impact on companies' earnings like it did in 2014 and 2015. Very similar conversation with oil. We've seen a big recovery, and we're back to levels where now year-over-year you're not losing a lot of earnings from companies in the energy sector, and so that's helped earnings tremendously. And this next slide shows that. With about 90% of S&P 500 companies in, we're most likely going to be over 29.39 here, which you can see is almost at an all-time high. So next quarter, following quarter, these are all going to be, the estimations are all for new all-time highs on earnings. And remember, over the long run, the stock market really tends to follow earnings. And if we were to have corporate tax cuts, individual tax cuts, fiscal stimulus in the measure of infrastructure spending and deregulation, all of these estimates probably go up from here. And that is what drives stock prices. It doesn't mean that it's a free lunch. It means that the deficit's going to go up, and at some point we may have an issue with that if interest rates go up too high, if interest spending on the annual budget gets too high. Those are different types of risks. But in the short run, I think that's why we're making the case for risk assets for the medium term, we'll call it. High yield, nothing too special about high yield. We're getting paid a little less to hold it than average. We do like high yield because we like aggressive assets. The spread got to as low as 4.5 last time before it ballooned to like 7. So it's getting to the point where we're not getting paid enough for the risk that we're taking in the high yield space. So we're monitoring that. But again, bonds are pretty tricky right now, and a yield spread is very nice to have, and you want to be careful of where you're going and how far on the curve you're going. But we do prefer credit risk to interest rate risk at these current levels. How to navigate. Since the World Series was just a couple weeks ago, I figured blocking and tackling was out now, at least for a little while, and pop-ups and grounders. So it's the fundamentals of winning, and we want to make sure that we focus on the basics so that we can win our game. You know, and each of you on this call, you have your own game, and it's not always about beating a benchmark or beating the market. It's about what is going to get you to your goals with the least amount of risk. And risk comes in many forms. And so we really want to make sure that we're looking at our own game and not worrying about anyone else or anything else. With that said, there's a lot of cash on the sidelines right now, and that cash has got to go somewhere, because right now it's earning next to nothing. Now, over the last 17 days, banks, you know, probably are going to start giving us a little bit more interest rate now that interest rates have come up. So maybe you'll get a little bit on your money, but cash is definitely not a good long-term asset for growth. You're going to be losing to inflation. So this is an astronomical amount of cash on the sidelines. This cash has got to go somewhere. One of the things that we do look at is the fact that retail investors like to chase returns, and there have been many economists and market strategists who have looked at trailing 5-year returns and where investors, in particular retail investors, put their money. And usually what the trend is that retail investors, they look 5 years back and they say, what asset classes have performed the best over the last 5 years? Well, something's happening this year that will help move those trends to equities. 2011 was a very difficult, very volatile year for equities, and that year is falling off. And so you're gonna have 5-year returns start to look a lot better in global equities, and that could imply that money will go from maybe cash, maybe bonds, into some of these global equities. So that's one thing that we want to keep an eye on. When we're looking at a valuation metric like this one, It's changed a lot because rates have gone up a bit, and the S&P has done pretty well. So these have come closer, but there's still a gap there. You're still getting paid a higher earnings yield for the S&P than you are a risky bond. And so in history, this has been when there's been a gap where the earnings yield has been above the bond yield, just tells us that relative to fixed income, stocks are more attractive than fixed income. Over here in 2000, fixed income was a lot more attractive than stocks. And so this is just a valuation metric that we like to look at, so that we look at relative valuation, stocks versus bonds. And then I know I've gone over this before, but for those of you who haven't seen this slide, for those of you who have, I've got a wrinkle that I'm going to add here. Those of you who have not seen this slide, let me go through it very quickly. Global GDP, basically there's an 80-20. 20% U.S., 80% global. Global stock and bond markets, 36% U.S., 64% global. U.S. investor allocation, 75-25. I'm rounding, but most U.S. investors invest in U.S. equities for a majority of their portfolio. If I saw a presentation by Jeffrey Kleintop of Charles Schwab, and the slide, I wanted to put it in here, but it was not for, it's for investors' use only, so I didn't want to put it in here, but I can give you the gist of it. It had about 25 countries, and it had how much they invest in their own stock market, and I just picked a couple of them. Greece, about 65% of Greek citizens invest in the Greek stock market, 65% just in Greece, and then 35% outside. Chile is 60%. Japan, like the U.S., 75%. And then he took it a step further to say some of these stock markets actually look a lot like sectors. And so he pulled out Canada for an example, and he showed that the MSCI Canadian index lined up very closely to 1.3 times the MSCI World Energy Index. So basically, the Canadian stock market it's like investing in 1.3 times the World Energy Index. So if you're Canadian, and Canadians they were like 55% in their own stock market, so that means that they're basically 55% in 1.3 times the World Energy Index. And I don't think anyone would really recommend to put that much into one sector like that. Japan, the MSCI Japan Index lined up very closely to 0.6 times the MSCI World Financial Index. So Japan, very similar to U.S., 75%. So basically 75% of their portfolio lines up very closely, 0.6, with financials. Probably not a type of portfolio that you're going to want to have. It's just not diversified enough. MSCI USA Index lined up very closely to 0.9 times the MSCI World Information Technology Index. So 75% of this U.S. investor allocation in stocks here is very closely lined up with the tech index, in IT, Information Technology Index. So probably not something that you're gonna want more diversification than that. And I know it's making these things very simple, but having assets outside the United States is not a bad thing. And over the last 5 years, and I have a slide to show this, it's been hard to convince people of that because the S&P 500 has done so well. But I'll hopefully try at the end of this presentation to show you a little bit of why we might want to have some assets outside the United States as well. That's enough for that slide. We've got great PE multiples for emerging markets. They're not bad for the U.S. and they're not bad for developed international. I'm not going to spend too much time there. Commodities, I already talked about commodities a little bit. Something that a lot of our investors have been questioning why they own commodities in their portfolio. This is prices of commodities, Bloomberg Commodity Index. You can see it's almost 2 standard deviations away from its median value there, and that's very common with a lot of these commodities, except with the exception of some of the precious metals. You got silver, maybe only half a standard deviation away, and then you've got gold pretty much at pretty much 0 standard deviation, maybe a little bit over its price range over the last 10 years. If we do have a President Trump that adds in tax cuts and infrastructure and deregulation, and we see some inflation, these things will do well. They should do well. Down here, commodity prices and inflation. You can see it's not a one-for-one relationship, but they jive a lot. And as inflation has been coming up, so too has the commodity index. And so this is a very good place to hedge our inflation risk, which is something that we want to do inside the portfolio. So there is a reason that we're owning global commodities, and this is prices are low, hedge inflation, and they're lowly correlated. Those are the 3 reasons why we want to own commodities. Something that we actually reduced some exposure to. We never get rid of asset classes altogether. We're not that smart at predicting what's going to happen. Every once in a while we get lucky. We decreased our exposure to REITs a while back, and it was with the theory being that when interest rates increase, the folks who have reached for yield are going to get hurt, because when yields on a treasury go up from 1.6 to 2.25, you've got other options now. And so would you rather be in a REIT that's paying you 3.5, or would you rather be in a treasury that's paying you 2.25? Lots of risk, very little risk. You can see that the difference is not a lot. And so what does the market do? The market says, okay, well, I need to make sure that rate on the REIT is higher, and so I'm going to make the market value of the REIT decrease immediately. And so since October 1st, the Lipper Global Real Estate Index has lost 9%. So REITs have lost 9% since October 1st. The Global Bond Index has lost 6% since October 1st. You get the idea here. It's the interest rate sensitive places where people have been reaching for yield. If you look at municipal bonds, they've gotten hit, especially the longer dated municipal bonds. It's these things that people have been reaching for yield that have really gotten hit. And so utilities was another one that we lowered in the portfolio for the same reason. Bonds. We don't necessarily love bonds, but most portfolios, especially those folks who are in retirement or getting closer to retirement, you've got to have some safety inside of the portfolio. We never know when the next 2008, 2009 is going to happen. And when your portfolio, if you have it all in equities, is going to go from 100 grand to 50 grand. And if you're five years away from retirement and you've got, let's say, $2 million in assets, you can't afford for your $2 million portfolio to go down to $1 million. Now, a portion of your assets can be there, but you're going to need to start living on your assets, and so you need something that's going to hedge that type of a risk. And so one of the only asset classes that is negatively correlated to stocks is fixed income. And so hate them as much as we do, they're a necessary evil inside the portfolio. And since the election, bonds have gotten hit. Our bonds have gotten hit a lot less. Just to give you an idea, if the global aggregate's down 6, our bonds are down. Our bond portfolio is down, I'd say somewhere between, depending on which bond portfolio you're looking at, 1.5% to 2.5% over that since October 1st period. So we definitely want to make sure that we have something that if the unexpected happens, we can go to those safety positions in our portfolio for income and for assets that we need to live off of and for our goals. Putting it all together, you combine all of these asset classes together. You look at the S&P 500. What is this? Since '94 to 2015, the average return has been somewhere between 5 and 10%. The standard deviation is here. So for every unit of risk that we take, we're getting 0.38% rate of return. That's what a Sharpe ratio is. It's how much return are we getting for each unit of risk that we're taking. Russell 2000, we're getting 0.34 return for every unit of risk that we're taking. Developed International, we're only getting 0.13% return for the risk that we're taking. Emerging markets, we're only getting 0.07% rate of return for every unit of risk we're taking. You put them all together, and your standard deviation is lower on the entire portfolio, and you don't give up a ton of the return. And so you end up with a better Sharpe ratio, a better return for every unit of risk we're taking. That is ultimately what we're trying to get at. We're trying to get the Sharpe ratio, or the excess return for every unit of risk that we're taking. We want that to be as high as possible. This is over the last 10 years, from 2005 to 2014, where risk and return trade-offs have been. So you can see that story about commodities. This is why no one wants to own commodities in their portfolio, because we've taken a lot of risk and it's been very up and down, and we've gotten a negative return over 10 years. Versus the S&P 500, which has taken a lot of risk, less risk than commodities, but you've gotten paid for it handsomely. Call it 8%. Private equity, that's a really good risk-return relationship. MLPs, you're getting a pretty good return for the risk you're taking. Real estate, not awesome, not horrible. I'd rather be earning the same return as real estate in small caps and take 5% less standard deviation risk. So the point of this slide is we don't know exactly where. We know we can plot these for the last 10 years for sure. We know we can do that. It's easy. The hard part is over the next 10, 20 years, where are these things going to fall? And part of the policies that the new administration sets forth, it's going to change how we see some of this stuff. And that's what we're trying to implement into each and every one of your portfolios to get the best risk-reward relationship between all of these asset classes. I'm going to skip this one today. I'm going to skip this one today. I'm going to skip this one today. All right. Remember I said I'm going to try and show why we don't always want to own the S&P 500. So this is the more recent history. This is 2006 to 2015. So inclusive of the financial crisis. The S&P 500 annual return over this period of time has been 7.3%. And its volatility has been 16.3. So in relation to emerging market equity, Pacific ex-Japan, Europe ex-UK, UK, and Japan, the S&P has taken the least amount of risk and earned the best return, okay? That is why everyone wants to be in the S&P 500 right now, because you're getting rewarded healthy for the risk that you're taking. Now, if we were just to go back 5 more years, how does this change the picture? It changes the picture dramatically. Now you can see that if we just add a few more years, now we're looking for from 2000 to 2015, your average rate of return on the S&P 500 has been 4.1%, and your standard deviation is 16. An asset allocation portfolio, which is a mix of all of these, has earned better than the S&P 500 with a lower volatility. That's ultimately, over longer periods of time, that's the trade-off that you want. When you add all of these asset classes in, that's the trade-off. But when you have an asset class that in 2012 earned 16, 13 and earned 32, then 14, then 1.5 and 15, and year-to-date 6, that's a pretty good run for an asset class. You know, 3 years in a row, second best performer. You're gonna start to see, and this goes back to my point about looking back 5 years and looking at what's done the best and putting your money there. It doesn't always happen that these do the best in the future. And so I think equities are better than bonds right now, given everything that's happening, improving global economy, potentially inflationary type policies, growth type policies. But we'll want to be definitely cautious because there is some uncertainty out there as well. So investment implications, I think you guys probably already can tell. I'm a fan of commodities right now. We're getting a great price. I think in the long run, you're going to be happy that you own commodities. Developed international, market neutral, I like to take away from some of our fixed income exposure, to have some market neutral that's very similar in the amount of risk that you're giving up to have that. Emerging market equities, we do like. Small cap has been added to this list. If we do have some protectionism that happens, I think that's going to probably be a positive thing for small caps. The market thinks so as well. Since the election, small caps are up over 10% in a week and a half. Underweight fixed income, long duration, we talked about that. Domestic equities, I just prefer international right now with where the valuations are, but that doesn't mean that we're getting rid of our domestic equities. REITs, we have some, but less than we used to. Utilities, we have some, less than we used to. And then the U.S. dollar, I think the U.S. dollar has kind of gotten ahead of itself recently. And I think over the longer term, as some of these other economies, excuse me, as some of these other economies have some growth and start reducing their monetary policy, I could see the dollar start to reverse at a slow pace over a long period of time. So with that, we'll go ahead and open it up to questions. Nick will read off some of these questions.
Thanks a lot, Sean. At this time, like he mentioned, we're going to open up the webinar to for anyone to type questions in the GoToWebinar tool panel that should be on your screen. We'll give a few moments for people to collect their thoughts and catch up. It looks like you get off the hook easy tonight, Thien.
No questions. Really?
Yep.
Is somebody raising their hand? No? Okay. I guess no one has. I guess I answered all the questions. Pretty surprising. With that, thank you guys for joining. Next webinar is going to be the first of the year, so we'll go through a 2017 kind of what we expect. We'll have a lot more of the policy framework, and so we'll spend some time going through that and seeing how it's going to change our thoughts and our investment implications and how that'll change our strategy. But with that, I say good night, and everybody have a great weekend and a great Thanksgiving and holiday season, and Happy New Year to everybody. Thank you.